Closing your limited company isn't just a business decision. It can be a life-changing moment that, if handled wrongly, can devastate your personal finances and your family's future. I've seen directors get it badly wrong, losing homes, savings, and even the mental health. And it's simply because they didn't fully understand the consequences of shutting down the limited company. Listen, I've also seen directors navigate the process smartly, protect themselves, the families, and the futures. In this video, I'm going to break down exactly what happens when you close a limited company, any potential consequences if you handle it incorrectly, and clear steps you need to take right now to do it safely. Okay. Thanks, Chris Worden, Director First. Today, you're going to get a crystal clear view on what actually happens when you close a limited company, the legal and the practical realities. I'm going to talk about how closure affects you personally, credit rating, personal liability, future business opportunities, that type of thing. I'm going to talk about common pitfalls that directors stumble into. These are things like overdrawn directors' loans, PGs again, issues with the HMRC. And I'm going to go through real life case studies, people who get it wrong, people who work with us and get it right. I'm also going to share the exact 5-step action plan that we use here at Director First to protect directors and to ensure they come out safely on the other side. By the end of this video, you're going to know exactly what to do next to safeguard your personal assets and your future. So let's dive straight in. I want to talk about the number one problem when it comes to personal liabilities: overdrawn directors' loan accounts. Okay. Closing your limited company is not just a case of signing a few papers. Okay. Your company's debts, company's assets, got to be fully accounted for. And that includes any money that you borrowed personally from the company. Now, a lot of directors will be watching that going, well, I don't have any overdrafts. I've not taken any loans from the company. They don't know that they've got a director's loan account. And that's the worrying thing. When you owe the company money, it's called an overdrawn director's loan account. And this is where directors get caught out all the time. I'm going to give you a real life example. Okay. This is a guy who didn't end up being a client with us. Let's call him Ben. He is a builder from Manchester. Okay. He used the business as a piggy bank. You know, when there was money there, he would take it. He didn't really declare it properly. He did a little bit of salary. The rest, what he called as a dividend. Okay. He was taking about 100 grand a year out of the business, 12 grand of it salary. The other sort of 88 grand was what he classed as a dividend. And he assumed, okay, that he'd just go to his accountant once a year and they would sort out the accounts. Okay. When he rang me, I straight away, I said, right, let's have a look at what the problems are here. I don't want to penny off anyone out there until I've looked at absolutely everything and I'm confident of the route forward. And if there's an issue, I'm happy to work with you so you figure out what that issue is without taking a penny off you. And I'd looked through this and I saw his last set of accounts. He owed about 100,000 quid on an overdrawn loan account. And I sort of highlighted this to him. And I highlighted what the other issue could be is that since your last set of accounts, if you've took another 100 grand a year out, you probably owe the business closer to 200 grand because this guy owed the revenue 250,000 quid and he'd owed it for a few years. So he couldn't take a dividend out of a business that's become insolvent. Remember, a dividend is paid out of profits. If you're not making a profit, you can't pay a dividend. Anyway, we got into the nuts and bolts of it and I started asking him personal questions about like his personal assets. And he's like, why are you asking me this? It's like, I'm a limited company. It's nothing to do with you. And I'm like, listen, Ben, I'm trying to help you here. Okay. He's about to sign with another firm, by the way. And I'm like, have you discussed this yet? Have you actually gone through this? As the other firm asked these questions, and he went, no. Anyway, I sort of dragged it out of him, you know, and in the end, I said, listen, if you put this into liquidation, you've got a big director's loan account, you've got a fair bit of equity in your house. And the top and bottom of it was, I said, it's going to cost you about 90 grand. Okay. The other firm have said it's going to cost him 6 grand to go into liquidation. And that was all. So clearly Ben hasn't watched any of my videos on YouTube. He's didn't bother looking at our Trustpilot reviews, and he went with the cheapest option. And like clockwork, 6 months later, I get the email from Ben. Chris, I'm being chased for £200,000. I've got a letter before action from a solicitor. Can you do anything? So just so you're aware, if I give you that advice and you don't take it, I wash my hands of you. You don't have to use me. You really don't. Go out there, find someone that suits your situation. But don't make the mistake of going with the cheapest quote, especially if you've got an overdrawn loan account, especially if you've got some assets to protect. And the outcome of that is, well, it's actually still ongoing. I did help him out. I said, listen, go and speak to this solicitor. But it's going to cost Ben a lot more than what I told him, because he's appointed the liquidator now, and they're not really in any mood to do any type of settlement because, listen, this guy's got a lot of equity. He actually has rental properties as well. It's going to end terribly, okay? Let me tell you and sort of compare Ben to, let's call her Jane, okay? She owned a similar business with her husband in Sheffield. She approached us about a problem with the business, and I noticed that there was overdrawn loan accounts for her and her husband. Okay, so again, what we did is we go through this and we go, Jane, right, there's a problem here. You've got an overdrawn loan account. Can you pull me up a balance sheet? Because she had a bookkeeper. Show me what the state of play is today. And her and her husband owed about £200,000 of the company. Okay. So what we did at that point, we said, right, listen, the issue here, Jane, is if you get wound up, it's highly likely that the official receiver will come for all of that money. You must get this organized in principle before you make any decisions as to who you're going to use to liquidate. And that's what we did, is we sort of found out what our proposals were to pay that overdrawn director's loan account, because she had quite a lot of equity in a house, very little mortgage. It was quite a big house in a posh part of Sheffield. Yes, there are posh parts of Sheffield, okay? And what we decided to do with the insolvency practitioner, we've gone to him and said, listen, we know that there's very little room for a discount here because of the equitable position. But what the insolvency practitioner has allowed is for them to repay the director's loan account over 3 years. And there is a little bit of a discount. So it takes the immediate pressure off them, and they're just going to have to pay it back over the next 36 months. Okay. And the key thing is, though, is she was aware of it before she made any decisions. We did all that work. We put it to the insolvency practitioner. The insolvency practitioner agreed it in principle. Obviously, they can't make any formal agreements until they've been appointed. But the key thing is you've got overdrawn loan accounts and you've got equity in your property. You've got to get these deals done quickly. So what you should be doing, if something I've said's worried you, you need to check your director's loan account balance, either with your accountant or with your bookkeeper. Okay. If you don't have any of those, get in touch with us and we'll help you understand your position. Because if your loan account's overdrawn, you've got to seek advice quickly to manage it if you're hurtling towards insolvency. Do not wait until liquidation is underway. You've got to address this immediately. The money that you owe on an overdrawn loan account is going to be asked to be repaid by the liquidator. You have to get a deal done in principle before you appoint them. If you're talking to a liquidator at the moment and you've stumbled across this video and no one's mentioned an overdrawn loan account, that's a red flag to stop. Okay, stop and take stock. Have that conversation with the liquidator. Go, I believe I may have an overdrawn loan account. How's it going to be handled in insolvency? If they're not willing to discuss this with you before you appoint them, again, it's a bit of a red flag. Listen, with this thing, it's so important. This is the area where people get made bankrupt and they can lose a house. If you're concerned about an overdrawn loan account, pick the phone up to me. Okay. Problem number 2 is personal guarantees and the impact on your credit as a director. Because when a limited company closes via an insolvency, any personal guarantees that you've signed, they don't disappear. A personal guarantee means you've personally promised to repay company debts if the company can't pay. And that could be it could be landlord, it could be rent, it could be dilapidations on the building that you're in. It could be a C-bills loan, a recovery loan. It could be just a normal loan with like a funding circle, IWOC, and capital on tap. And there could be finance companies. There could be suppliers. And if you've signed a PG, they can be enforced quite aggressively once the company closes. So the key thing with PGs is you've got to have a plan what to do with them if your business goes into insolvency. And actually, the step before that is you've got to understand which ones you've got them with. So we'll help you do that. Send us your agreements. We'll review your agreements for free to help you understand what you've signed PGs on. And again, it could be overdrafts, credit cards, bank loans, supplier debts, a whole range of things. And you've got to have that in your head as you're sort of facing insolvency. And the key thing with PGs is in 99% of cases, you're going to be able to restructure them. Okay. And that could mean that once you're in insolvency and they serve notice that they're going to enforce the guarantee, is you pick the phone up to them, or even better, you speak to someone who can do this on your behalf. I have done a great podcast that I think dropped a couple of weeks ago with Gary Whitehead of AFT Assist. And we talk about PGs and how you deal with them. And the key thing is you've got to be proactive. You've got to be responsible. You've got to take action now. And as long as you're communicating with the institution that's give you the personal guarantee, the chances are is they'll allow you to pay over a longer period of time. And that could be years. You could cap the interest. The worst thing that you can do, though, is bury your head in the sand. Because if you bury your head in the sand, that's where they're going to take action against you. Now, if you deal with a personal guarantee proactively, the chances are, not in every case, but in most cases, it won't affect your personal credit score. It will affect your personal credit score if you bury your head in the sand and you force the lender to take action against you. Okay. Another issue I'm seeing at the moment, problem number 3, is HMRC debt and these things that are scaring the life out of people called personal liability notices. Okay. So a lot of directors think when you close your limited company, it will erase HMRC debts. And yeah, VAT, corporation tax, PAYE, it is an unsecured debt. And in an insolvency, it goes into the insolvency. But the HMRC is getting tougher than ever. And what they can, and they've started to do, is issue things called personal liability notices, PLNs for short. And it's if they believe you've deliberately avoided paying taxes, okay? And this transfers the company tax debt onto you personally. And it's being used more and more. So the key thing, again, if you're behind with HMRC, you've got to communicate with them. You've got to let them know what's going on. And also, if a personal liability is you're worried, you want to be picking the phone up to us straight away. If you've been issued with a personal liability post-insolvency, please get in touch with us. What we can help do is actually put you in touch with somebody who can help you sort of fight and perhaps negotiate that. So problem number 4 is the impact an insolvency is going to have on a director being able to run a company going forward. So if you close a limited company incorrectly, especially if you're found guilty of misconduct, you risk being disqualified as a director for up to 15 years. Okay. So disqualification in most cases is going to ruin your business career and it's going to severely impact future employment. So there are some tactical steps to try and avoid disqualification. Listen, the first thing is keep detailed records throughout any type of process. So let's start with, you think you're insolvent, you can't pay your debts when they fall due, liabilities more than your assets, you're getting a lot of pressure. But you want to continue to trade? Well, the first thing, pick the phone up to somebody like me. Remember, we get about 600 inquiries a month. We don't do 600 insolvencies. A lot of our calls are free advisory. But if you speak to an insolvency professional and they agree with you that you should carry on, what you want to start doing is emailing yourself the rationale. If you're selling assets, email the rationale as to why you're selling assets. If you are going to be taking on more debt, you're taking on more debt from suppliers. Again, you've got to minute your rationale as to why you have decided to do that. And it needs to be, remember, if you're insolvent, in the creditor's interests. Another thing you want to be careful of is preferential payments to certain creditors. So if a business has become insolvent, your conduct's going to be scrutinized, and you're meant to treat all creditors equally. So let's say you owe your Auntie Mavis 50 grand, there's 70 grand in the account, you become insolvent, you know you pass the point of no return, and you pay Mavis off. Well, the appointed insolvency practitioner is going to chase Mavis for the money, and if they can't get the money out of Mavis, they're going to come and turn on you, make you personally liable. It's the same for, like, paying off personally guaranteed debts towards the end and not paying HMRC, not paying suppliers. Now, there are scenarios where towards the end of a company, you are still going to pay certain suppliers. And that, as long as you can justify paying that supplier is in the interest of the creditors, that shouldn't be an issue. And an example that comes to mind for me is you do this, so you pay a supplier to get some supplies dropped off at site that will allow you to finish your job and get more money into the company, again, ensuring a better dividend paid out to creditors. Again, if you're worried about that, the idea is for you to pick the phone up, because I give the general advice here, and what we really want to do is go into the specifics of what's going on for your situation. So the key message here is, when you are considering insolvency, okay, there are things that can bite you on the backside. And the biggest problems that I see with directors is they really just don't know what questions to ask when it comes to insolvency. They pick the phone up to an insolvency advisor or an insolvency practitioner, and the first thing out of the mouth is, well, what's this going to cost me? What's the cost to liquidate? It's not the thing you need to be focusing on. Yes, cost is obviously a factor, but you want to know what this is going to cost you in the long run, in full. You want to know what type of issues are they going to be landed at you personally if you put this business into an insolvency process. So I hope you found my video useful. Chris Worden, Director First. If you want some free and independent insolvency advice, give us a call. If you drop a comment in the section, I will respond to it personally. Like and subscribe to the channel. Thank you for your time. God bless you. Bye-bye.